You're watching today's market comment here at xm.com by Haralabos Pisuros. I'm Christina Marucos. The U.S. dollar pulled back on Wednesday and continued trading on the back foot today after the ADP National Employment Report revealed that U.S. private payrolls increased by far less than expected in September, suggesting that the labor market is indeed feeling the heat of higher interest rates. Traders rushed to lower their implied Fed rate path, and they are now assigning only a 40% probability for another rate hike by December, while they expect interest rates to end 2024 at 4.6%, notably below the Fed's projection of 5.1%. Following the weak ADP print, investors will now be eager to see whether non-farm payrolls will also miss their forecast on Friday. Non-farm payrolls are expected to have slowed to 163,000, but the unemployment rate is expected to have ticked down and wage growth to have remained elevated. Such a report could revive trust in the Fed's higher-for-longer view and perhaps allow Treasury yields in the U.S. dollar to rebound and extend their uptrends. The Japanese yen ended Wednesday on the back foot despite Tuesday's sharp rally that stoked speculation of intervention. That said, the Japanese currency recovered again today during the Asian trading. Attention for dollar-yen traders will now start shifting towards tomorrow's U.S. jobs data, where a decent report could result in some recovery. Well, the big question is whether this recovery will take the pair back above 150 and whether such a breach will trigger a second round of intervention. Nonetheless, even in the case of intervention, the bigger picture is unlikely to be altered much. As long as the Bank of Japan keeps Japanese government bond yields capped and the Fed remains willing to keep interest rates higher for longer, dollar-yen may be destined to rebound. Wall Street took a breather following the weaker-than-expected ADP report and the lowering of the market's implied rate path, with the rate-sensitive Nasdaq gaining the most. That said, the earnings season kicking off and Friday's non-farm payroll still pending, it seems unwise to assume that Wall Street hit a bottom. Elsewhere, oil prices tumbled yesterday as the Energy Information Administration reported that finished motor gasoline supplied, a proxy for demand, fell to its lowest level since the beginning of the year last week. Although OPEC Plus members maintain output cuts to keep supply tight, it seems that demand concerns are starting to be reflected in prices, and with China and Eurozone, the world's two largest oil consumers behind the U.S., facing economic challenges, those concerns may continue to grow. Thank you for watching today's market comment here at xm.com.